Welcome back guys to another Zero DTE video, and today Coach Ernie is going to be talking about market moves, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description to join the world's #1 Zero DTE trade destination. Enjoy guys.
On your evening retrospect today on the email that you sent out, you said when price sits under a big volume area and volatility dips below 20, it can feel safe. It's not. So I'm assuming, and then you go on to say, the market is a comet's coiled. We hovered below 59. 100 a major shelf, no breakout, no clear direction, just noise. So I'm wondering if you're thinking that we are going to go down to the next high volume node, or when you say it's coiled, do you mean coiled up or down? That's one question.
No, coiled means that volatility is getting compressed and it's getting low. I'm not saying that price is going to go down. Usually when volatility gets low and compressed, price is going up. Exactly. And then at some point there's a release because it's like lack of energy, and then it's like the Big Bang Theory. When there's a lack of energy, all of a sudden you get a big burst of energy. And so that's what it means by it's becoming coiled.
And you say be careful. You're saying that because it's getting compressed and there's going to be some sort of explosive move.
Yeah. So let's look at the pattern of volatility by looking at the VIX. And when you look at the VIX, what do you see its pattern basically? Its most basic pattern. Its most basic pattern is that it explodes up and then immediately falls down and then finds some bottom and then explodes up again.
Okay. Yeah.
Would you agree with that?
Yes. Different levels of explosiveness, but yeah, basically.
Yeah.
I don't want to say head and shoulders or anything, but triangles up.
Yeah, it's not head and shoulders. It's nothing like that.
The pyramid.
It's in many cases, the real big ones, it's the physical action that you get when you roll a ball off the table. So let's say it goes way up, and then you roll the ball off the table, and then it bounces up, then it comes down, and it bounces up again, but a little lower, and then it bounces again a little lower than that.
Yeah,
it's kind of like
some really sharp edges.
Yeah, but that's essentially what happens with volatility too.
Okay,
this is a good example.
So we're still in Goldilocks land.
We had this big move up and it came down, and now we're compressing and waiting to go up again. And we're going to go up again. I just don't know when. It'll be some little short, sharp shock, or it could be a long, sharp shock, or a long, deep shock. Who knows? It's all kind of random, but it will happen. And it usually happens as we become more and more compressed as we're coming down. It just seems like a natural order of things.
Okay, so now I guess I'll switch back to what we were doing a couple weeks ago, because it's evolving from there, but trying to do an out of the money fat tail kind of trade. And so I think I had the June 4th 5,700 puts as a center strike. And we talked about this, and you yelled at me because it wasn't wide enough. I think maybe I only went 20 wide.
Yeah, you did a 20 wide or something.
Yeah, but I paid 40 cents for it. And I was like, at one point I was really optimistic, and I was like, I'm going to put in the price target for $3. And then I was like, that's interesting, but whatever. And then so I had it for 95 cents GTC, and it's bouncing all around, but it was never getting hit. And then I just figured, what the heck? I just want to get a good percentage gain. So I put it in for $80 and it got hit 80 cents. So that was 100% gain. Trying it my very first, not knowing what I was doing at all, fat tail trade.
That was just dumb luck and whatever. That's not optimal, but that's fine. It was a cheap, good asymmetric trade. That's what it was. But what we're going after is an area where there's true convexity, where when it hits there, you generally get a much larger return. We're not looking for the 100% return. We're looking for the 500, 1,000, 5,000% return.
Okay.
And that's where that price lies. That's why I talk about this price between 25 cents and 50 cents. Seems to be like a market idiom or standard. That's the level where traders, they don't play the game anymore. It just drops off and then goes down to zero. So if you look at options change, you'll often see it. It'll be just as it gets to about 50 cents, then it starts dropping off quickly, and then everyone's out of the game. So it's that drop off right there. That's where you want to be. There's probably a better way to explain it, and it's contained inside a book like this here, The Statistical Consequences of Fat Tails, but it's very math intensive, but it's definitely in here. It will explain why you want to be there. That's where convexity is, where the curve starts. So for example, if I were looking at any of these big spikes up, like this real big one here or wherever, where would you rather be? If you were going to capture this move going up, would you rather be right here or right here, capturing the move going up? Obviously, you would rather be right there, right? Or on this one right here. Would you rather be right here or would you rather be right here? Is this making sense?
Yeah.
So this right here is right where that 25 to 50 cent range is. This is like where that 80 cents, 90 cent range is. Maybe that'll sink in a little bit.
Can you say it one more time?
Here is where those prices are between 25 and 50 cents. Here is what you were going after, that 80 to 90 cent. I'm just using this as an analogy. If I were trying to capture this move up, and ultimately I would like to capture it up here or even here, I would rather be here than here.
Got it. Very interesting. Okay.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit the subscribe button and the like button below. If you're interested in becoming a pro trader, remember to check out the link in the description for Ernie's Skool Community.